Do you have clients that are considering or should be considering long-term care insurance for themselves or possibly for parents? Hello, this is Brian Fisk with Reverse Mortgage Strategies. I'd like to discuss a subject that may or may not be on your client's radar. I'm talking about the potential need for long-term care assistance during their lifetime and how to provide for this eventuality. Independent and self-reliant seniors should have a plan in place sooner rather than later. A decline in health without a plan can stress the entire family and can be financially devastating. While most seniors would prefer to remain in their home and age in place, the fact is that 70% will need some form of long-term care, and 40% of people who reach age 65 will enter into a nursing home during their lifetime. 2.44 years is the average length of stay. Based on average cost in California, that can snowball to $330,000 or more. And that's for the average cost of care and the average length of stay in an average facility in today's dollars. It can be much, much more. Planning ahead is essential. What kind of care is preferred and how can this be paid for? I'm going to review 4 options for dealing with the cost of long-term care. Option 1, Medicare. Seniors depending on Medicare to provide for these needs must understand that the Medicare asset and income limitations are complex, can change every year, and if you do qualify, you must re-qualify every 3 months. Put as simply as possible, to qualify for Medicare long-term care assistance, you'll be required to spend down your nest egg first in order to meet the eligibility requirements. In addition, the system may control aspects of your care, where you can stay, and the treatment you receive. For most financial planning and advisory clients, this is not a viable option. However, for some clients, for example, first-generation wealth clients, this could be the outlook for their parents. A plan must be put in place to avoid the scenario of a financial planning client facing a potentially 6-digit outlay for their parents' care and possibly having their parents living out their final days in their home, which is again very expensive and can put a serious strain not only on the finances but on your client's quality of life. The Medi-Cal option should be avoided if at all possible. Option 2, long-term care insurance. This coverage protects assets and allows your client to retain control of their health care, where and how they live at the point in their life when they need assistance. If your client is one of the 70% of Americans that will require some form of long-term care, this is a good option. But this coverage is not cheap. However, many long-term care policies today are in the form of a life insurance policy with a long-term care rider, so that if long-term care is not necessary, or if all of the benefit is not consumed by long-term care costs, the heirs, the children, will receive a life insurance payout for the remaining benefit. So although this insurance is not cheap, it's not use it or lose it. This illustration shows a policy for a 65-year-old woman that will pay a death benefit of $250,000 or will cover $250,000 of long-term care costs. At the California average cost of around $10,000 per month, it would pay the cost of nursing home care for 25 months, about the average length of stay. It can also be used for in-home care and other lower levels of care, in which case it would last longer. The premiums are $5,119 per year for this coverage, or about $427 per month. If we're talking about a married couple, this cost could be double, and if the couple is older, the premium would also be higher. So how should your client pay these premiums? If their income is sufficient and the premiums can be paid monthly from their income without restricting them financially, of course it's an option. If your client's income is not sufficient and they cannot comfortably make the payments, they might consider a reverse mortgage. Many seniors plan to retire, pay for health care, and leave their home to their kids. But what winds up happening is, because of the high cost of this care, they're forced to sell their home and move into an assisted living facility where the proceeds from the home sale are consumed on average in 2.5 years. Why not tap into the home equity now to buy long-term care insurance so that your client can remain in the home where they prefer to be and where long-term care costs can be half of what they'd be in an assisted living facility? And of course, an additional benefit would be that if your client currently has a mortgage payment on their home, with a reverse mortgage they would eliminate that mortgage payment. For your successful and independent clients who have worked hard and earned the right to control how and where they will live out their retirement, the reverse mortgage combined with long-term care insurance can provide that control and security. The third option is to self-fund. If your client has the resources to cover the cost of long-term care in addition to their other expenses, self-funding may be an option. But it's critical that they understand the cost and do have the resources to cover those costs beyond the average length of stay. If they prefer to self-fund because maybe they don't like insurance or have health issues that would make qualifying for insurance difficult, but don't have the savings to pay for the cost of long-term care out of pocket, an FHA-insured HECM or home equity conversion mortgage might be the best option. The HECM provides a line of credit that grows each year at a rate, as of this video, around 6%. This growing tax-free liquid account can provide the funds to pay future long-term care associated costs. They should apply now, number one, while their finances are healthy so that they can qualify for the loan. Number two, so that the line of credit can grow as much as possible. At 6%, the line of credit will double in about 12 years. The average age of entry into an assisted living facility is age 79. In this illustration, a 65-year-old male secures a $386,000 initial line of credit. By the time this client is 79 years old, the line of credit has grown to $895,000, sufficient to cover long-term care costs for well over the average duration of stay. This is an excellent option for your client that may not like the idea of insurance or may not qualify for insurance because of health conditions, or because of those conditions the cost is prohibitive. A fourth option would be a combination of long-term care insurance and self-funding. These strategies are flexible. You may have a client that's willing to self-fund up to a point and use insurance just for additional protection. We can customize a solution that makes sense financially. If you have a client that is facing these concerns about what their late retirement will look like, give us a call. With some basic information, my team can work with you to put together a plan that addresses those concerns. For more on this subject, including additional scenarios and variants on this strategy that might perfectly suit a client you have now, please contact me regarding our upcoming webinar that goes into greater detail and qualifies for CFP-CE credit. And for additional brief videos on scenarios that utilize a reverse mortgage to benefit senior clients, you can visit reversemortgagestrategies.com/advisors. This is Brian Fisk with Reverse Mortgage Strategies. Thank you.